roundup covering what's important to accountants and advisors across the month of May. Inside this month, we'll look at the ATO warning on trust distributions, also an AAT case on meal allowances that highlights some of the common misconceptions. But first up, the budget measures and the problem areas. The federal budget was handed down this month. Announced in the budget was an extension of the $20,000 instant asset write-off, this time ending on 30th of June 2025. Michael, there's been a lot of consternation about this announcement. Have there been any developments?
The short answer is no positive developments anyway, and we're not likely to see any real clarity on this, unfortunately, until late June, probably at the earliest. This is a bit of a mess, really. You might recall that back in the 2024 federal budget, the government announced that with the temporary full expensing measures ending at the end of the 23 year, the government would basically have a 1 year, $20,000 instant asset write-off threshold for the 2024 year. So that's the current financial year. However, the bill hasn't passed through Parliament. Basically, where things ended up at this stage anyway is that the bill passed through the House of Representatives, ended up in the Senate. The Senate basically sent the bill back to the House of Representatives with a couple of amendments around the instant asset write-off rules. The first one was to suggest that the cost threshold should be increased from $20,000 to $30,000. The second thing the Senate wanted was for the turnover threshold to also be increased from the small business entity threshold of $10 million up to what we kind of use as the medium business entity of $50 million. The House of Representatives considered those changes and rejected them and sent the bill back in its original form back to the Senate. The Senate disagreed again, sent it back to the House of Representatives, and that's where things stand at the moment. And basically the Senate isn't really meant to sit again until late June. And so even if we see some developments over the next couple of weeks in the House of Representatives, we probably won't have any real clarity on this until later in the June, which is getting very close to the end of the financial year, when this measure is actually meant to expire anyway. So as a measure intended to incentivise small businesses to go out and spend money, it's probably not going to do its job. The other thing just to note is within that bill is the government's small business energy incentive as well, also announced over a year ago now, which was again meant to encourage small businesses to go out and spend money electrifying the assets that they use in their business activities, and also improving the energy efficiency of the assets that they use in their business. That measure is due to expire on the 30th of June 2024 as well. You basically need to have bought the asset and started using it in your business by 30 June 2024 to be able to access the 20% bonus deduction that would be available under that incentive if and when the legislation finally passes. So not only do we have some uncertainty around the instant asset write-off rules, we also have uncertainty around this small business energy incentive. It might pass, but at this stage, we don't really know what's going to happen. I guess it just means we need to be conscious of that as we get questions from clients in terms of decisions they might look to be making over the next month or so. We just need to be aware of the fact that those bits of legislation still have not passed. And there is some uncertainty around how this is all going to play out, particularly around the instant asset write-off rules. Now, the federal budget for this year, we have had the government announce another 1 year extension to the $20,000 instant asset write-off threshold, which would apply across the 2025 income year. But look, given that we don't even have legislation in place for the 2024 year, I suggest we don't hold our breath. Around the 2025 year, we'll have to wait and see, I think, how this plays out. So at this stage, we have a couple of announcements, but nothing more than that really, which isn't ideal, particularly as we get to the end of another financial year.
Is there anything else in the federal budget that we should be aware of?
Well, it's a pretty light federal budget from a tax point of view. I mean, I don't remember there being that few tax-related measures in the federal budget for certainly as long as I've been involved in the federal budget process. But there is one thing I just wanted to point out at this stage, and that is the government has announced that there will be some changes to the way the CGT rules work if you're a foreign resident. Now, the details are pretty sketchy at the moment, pretty vague. We don't have a whole lot of detail in terms of what this will really look like. But the government is suggesting at a very high level anyway that there will be an expansion of the CGT regime for non-residents. How far it's expanded, we don't really know at this point. Now, you might be aware that if you're a non-resident at the time a CGT event happens, then you will normally only be exposed to CGT in Australia if the asset is classified as taxable Australian property. And there's only very kind of limited categories of assets that are treated as taxable Australian property. It includes things like land and building located in Australia, mining rights relating to Australia. If you hold shares in a company and that company holds land or buildings in Australia, those shares might be taxable Australian property, just depending on the situation. And assets you use in a business here in Australia, also typically treated as taxable Australian property. Now, the government has said that the scope of these rules will be expanded. We just don't know exactly how that will look. The other thing the government has noted is that there will be an expansion of the notification rules, so that certain high-value transactions relating to, say, shares in a company, for example, would need to be notified to the ATO. Again, we'll kind of wait and see how this all plays out. So it does seem like there are some changes probably coming. Might take a little while for those to flow through the system, because it does appear that there will be a consultation period before we see any bill before Parliament. But it's something just to keep an eye out for. This does look like there'll be some developments in this area. Now, the government has said that those changes will take effect basically from 1 July 2025. So they're not due to start in the very short term. There will be a little bit of a time period before any changes actually take effect, but something to keep an eye out on over the next maybe 6 to 12 months as we see some maybe consultation materials and then start to see some legislation, which helps to flesh out the detail of what these changes will actually look like.
So where to from here for this bill that's before Parliament? Parliament sits again in the very last week of June, and there are a couple of options that might occur. Number one is that the Senate does not insist on its amendments and passes the bill. The Senate might ask for a conference with the House to try and nut out a resolution. The bill might be laid aside, or it might become a trigger for a double dissolution. We'll keep you up to speed on our social media feeds. Now, what is not uncertain is the ATO's focus on trusts and trust distributions right now. Michael, the ATO has issued a warning on trust distributions. What are some of the areas in the ATO sites?
Yeah, well, the area of trusts and trust distributions has been a very hot topic over recent years, as many practitioners would be aware. And as we get to this time of year, this is often the time where advisors are working with trustees, just in connection with that year-end trust distribution process. And I think if you look into this area in any sort of detail, you realise that there are a huge number of issues that potentially crop up and need to be managed by people who are involved in that process. The ATO is aware that there are a whole range of issues, and the ATO has provided a bit of an update just in terms of some of the things that trustees and therefore also their advisors need to be conscious of as they're working through that process. Let's have a look at some of the things that the ATO has said that it will be looking at and that trustees really need to focus their attention on. I guess a lot of this comes back to knowing the trust deed pretty well. And so, for example, one of the things that needs to be checked is the vesting date of the trust. Now, the vesting date of the trust isn't necessarily the date the trust comes to an end. Often what happens there is if you're dealing with a discretionary trust, when the vesting date occurs, it means that a lot of the discretion that the trustee might have had up until that date basically goes out the window. Often one or more beneficiaries will end up being automatically entitled to income from that point onwards. So you see that quite a significant change can happen once a vesting date occurs. As a trustee, you'd want to be aware of when that date is coming up or when it might have already happened. So that's one thing that the ATO points out. You just need to be careful about. The other thing that is often something we need to look at the trustee pretty closely about is who the beneficiaries actually are. And it seems almost silly to point this out, but this is something that comes up over and over and over again. We get a lot of help desk questions where this ends up being the key issue. Really understanding the trust deed and who is able to receive distributions from the trust. The trustee can't go and distribute to someone if they're not an eligible beneficiary under the trust deed. You might find, depending on the type of trust you're dealing with, that trust might have different income beneficiaries and capital beneficiaries. For example, that might be the case if you're dealing with a testamentary trust, for instance. So that, again, is something that needs to be looked at very carefully. Just because someone is related to the controller of the trust, or there might be a related entity, doesn't automatically mean that it is an eligible beneficiary. We need to check that very carefully. One of the other things the ATO has pointed out is issues that tend to crop up around family trust elections, and I'm not surprised by that. This is a very complex area of the tax system, and it is an area that is very easy to misunderstand or to make inadvertent errors. So if you have clients with trusts and those trusts have made a family trust election or one or more interposed entity elections, we need to very carefully understand how the rules around family trust election work, and be conscious of the fact that sometimes we could be causing problems if distributions are being made outside of the defined family group. Again, when we have related entities that might form part of the wider group, related companies, related trusts, managing those rules can become quite difficult, particularly where there are maybe different generations of a family involved, where there are siblings involved. The complexity of that system really increases as you start to go beyond an immediate family group. So something that we see lots of issues around, and we know that people do get this wrong from time to time. It's an area that we need to pay careful attention. The fact that the ATO is referring to it should also just be a trigger for us to make sure that we're on top of those rules and that we're really being aware of who is in and outside the family group. Don't make assumptions. Don't just assume that someone's in the family group. It really does need to be checked. Aside from that, the ATO points out things like being aware of the possibility of streaming, but again, that there are strict requirements to be able to stream franked dividends or capital gains to particular beneficiaries. Often, step one is going back to your trust deed. So often the answer is going to be found in or around the trust deed, so we need to know that trust deed pretty well. Now, aside from that, there's a whole bunch of other things that need to be looked at. Timing issues, getting the timing right. What does the trust deed say? The trust deed might require the trustee to do something before 30 June. 30 June might be too late in some cases. Again, how do you know? Look at the trust deed. It will tell you probably the answer to those questions. But there's a whole bunch of things we need to be conscious of. If you're a Knowledge Shop member, there is a checklist, a very detailed checklist that's available to you on the Knowledge Shop member site, which will run through those issues plus a whole bunch more. It can be a really handy thing to check through as you're working with trust. Each trust is different. The fact that you've dealt with one trust really well and covered all the relevant issues doesn't necessarily mean you're going to face the exact same issues with a different trust or that the answers will be the same. We need to look at each trust separately on its own merits. So lots of things to be aware of. It is a complex area. The ATO knows this, and there are lots of different areas that the ATO can potentially attack when it comes to trust distributions. So it's an area we need to obviously pay a lot of attention to.
It looks like there are some changes to how trust distributions are managed on the tax return. Can you tell us a bit more about what to expect?
Yeah, the ATO has indicated that it has some concerns in terms of the way that trust distributions are being reported, both on the trust tax return, but also from the beneficiary's perspective. And I'm assuming that has led to the ATO basically increasing the reporting that will be required by both trustees on the trust tax return, but also by beneficiaries of trusts. On the trust tax return, the ATO says there will now be some additional labels on the trust return relating specifically to CGT. So there will be 4 extra CGT labels that will be potentially relevant. If your trust doesn't have a CGT event for the year, then it's probably not relevant to you. But where we do have trusts that have CGT events, there's capital gain or loss, you'll find that there are some extra labels on the trust return that need to be completed. Now, when it comes to beneficiaries, there's also a fairly significant change because a beneficiary of a trust will need to start lodging an extra schedule with their return. It's basically a trust income schedule. The ATO says that it will basically replicate what you see in the trust tax return towards the end when we're looking at the statement of distribution, where you have details for each beneficiary and the different components of the distribution. So the ATO says that basically a beneficiary will be able to take what's on that statement of distribution page and it will effectively end up in their tax return as part of this new schedule. Just to make sure that there's no information that goes missing from the trust tax return onto the beneficiary's tax return. And I'm assuming the ATO is hoping that this will increase compliance when it comes to what's reported on beneficiary returns. Now, the ATO says that if you're the trustee, you obviously need to make sure that the beneficiaries have that information available to them, that they have a copy of that distribution statement so they can fill out that new schedule. If you have clients who are receiving distributions from managed funds, those distributions will also need to be recorded and reported as part of this new trust income schedule. Large managed funds hopefully will be all over this and will be providing clients with the details and where those details need to be reported on that trust income schedule. And if you haven't received that sort of information from a managed fund, you probably need to contact them, make sure that they're able to provide that information to you. So that's coming soon. For trust clients, both at the trust level and beneficiary level, just be aware that there are additional reporting requirements coming very shortly.
Now, for Knowledge Shop members, you can download that trust distribution checklist Michael mentioned from the Knowledge Shop portal, the member-only portal. Now, before the AAT this month was an interesting case where the taxpayer claimed around $28,000 of deductions for meal expenses without receipts. Matthew, how did that go for the taxpayer?
Mostly not that well. But this case deals with the substantiation exceptions that can apply when an employee receives travel allowances when they're travelling overnight in the course of work. But to me, I think the interesting aspect of this case is that it probably highlights some common misconceptions that I think some people might have around how these rules actually work. Now, when an employee receives a travel allowance for meals when they're travelling overnight in the course of work, there certainly can be some substantiation exceptions that apply. And that's subject and capped at the ATO's reasonable amount. And that tends to change each year. The ATO publishes new rates each year. Now, if they apply, they can help the taxpayer in terms of not being required to keep invoices, receipts, which are probably quite fiddly to manage when you're dealing with lots of small amounts. And in some cases, they can also help the taxpayer by not requiring them to keep a travel diary if that's required in the first place. Now, the taxpayer in this case, this AAT case, Mr. Duncan, he was a long-haul truck driver, and he was away from home during the year for about 283 days. So he was away from home for actually most of the year. And the taxpayer, he thought he was receiving a travel allowance. So what he did was he claimed $100 per day in terms of meal expenses, which happens to just be below the ATO's reasonable amounts for breakfast, lunch, and dinner. And that worked out to be a total deduction of $28,000 for that particular income year. Now, when you put $28,000 of meal expense deductions in your tax return, that's going to jump out. And not surprisingly, the taxpayer got a bit of an audit from the ATO. And to the ATO's credit, and they were probably being a bit more generous than they needed to, the ATO did allow the taxpayer to claim $8,000 of meal expenses. And that's because that could be, proved up, or corroborated through bank statements and credit card statements, where it could show that he did actually incur some expenses at restaurants and cafes while he was on these work trips. But the balance of that expenditure, the balance of that being $20,000, the ATO didn't think that was deductible, and that was the subject of the dispute. And in my mind, I think the taxpayer ran some arguments and held some views which are probably some fairly common misconceptions around how these rules, these substantiation exceptions rules, actually work.
What were the taxpayer's arguments in this case?
Well, first, and I've certainly heard this argument run before, is that the taxpayer argued that once he receives an eligible travel meal allowance, and presumably because this meal allowance is accessible, then that also should mean that the ATO's reasonable amount, well, they function as an automatic tax deduction, and he doesn't need to go out and incur the expense in order to claim deduction for these meals. The AAT, well, they disagreed, and they disagreed quite quickly. And fundamentally, that's because these rules are actually just substantiation exceptions. You still need to go out and spend the money. You still need to go out and incur the expense in order to claim a deduction. So failing that, the taxpayer went and produced some evidence of expenses that he incurred at the supermarket near his home, and he went to these supermarkets allegedly to buy groceries, which he would then take on these overnight work trips. But the AAT, they didn't really buy into that. These supermarkets, they were near his home, so there was no way for the AAT to to work out which groceries might have been consumed at home and hence private and non-deductible versus groceries that were consumed on these work trips. And I guess the point I'm trying to make is that people will look at these substantiation exceptions and they think that they don't need to keep any records. And unfortunately, that's just simply not the case. While these substantiation exceptions, they can certainly make our lives easier in the sense that we don't necessarily need to keep all our invoices, all our receipts, the ATO does make it quite clear that they can still ask you how you worked out the expense, and they can still ask you to prove up that you actually incurred the expenses. And the ATO's examples and guidance in this area suggests that keeping a diary, keeping a travel log of when you went on these work trips, these overnight work trips, how many meals you had on these trips, as well as keeping bank records and credit card statements to prove up that you actually incurred the expenditure, these are things that are going to go a long way in the event of an ATO review. And practitioners with employee clients that are receiving travel allowances, they really need to be careful in this area, especially if you're dealing with clients like Mr. Duncan, who are away from home for a lot of the year. These meal expenses, they might seem minor each day, but they can certainly stack up quite quickly.
And that's the roundup for this month. If your firm is not a member of Knowledge Shoppers yet, we'd love to show you what a difference we can make to the lives of professional advisors and professional accountants. Give the team a call or jump onto the website and book in a time to do a tour. We'll look forward to speaking to you soon. See you next month.